The market right now, if you value it, I'm sorry, I laugh because it's the market is more highly valued today than it was pre-pandemic, and that's ironic. What do you need to get to see a return to ultra low interest rates? You need deflation. You need some deflationary shock, kind of like the great financial crisis. We haven't gotten an official all clear yet on the economy, and in fact, still things could continue to deteriorate in the quarters ahead. The Wall Street Journal's reported about the number of people taking loans out of their retirement accounts to help meet living expenses. That's grown dramatically so far this year.
Hello and welcome back to Soar Financially, a channel where we discuss the macro to understand the micro. My name is Kai Hoffman, I'm the EdJR mining guy over on X, and of course, your host of this channel. And I'm looking forward to bringing back Jesse Felder. He's the publisher of the Felder Report, and we spoke to Jesse in early January. And of course, we have to catch up. What's been going on in the U.S. economy? And Jesse is one of the very few that tracks insider buying and selling. A really interesting indicator on where the market is. Like, how are earnings? What are his expectations for earnings coming out of the reporting season that's maybe after Q2 here? But what were some of the indicators? Like, how are the tariffs impacting some of the big box retailers and many other U.S. stocks here? So lots to discuss, of course, lots to follow up from our conversation back in January. But before I switch over to my guest, hit that like and subscribe button. It's a free way to support our channel, and we tremendously appreciate it. And of course, it doesn't cost you a thing, so why wouldn't you do it, right? So, Jesse, thank you so much for joining us again. It's good to see you again. Thanks for coming on.
Well, likewise, Kai. Thanks for having me back.
Yeah, really looking forward to this, Jesse. Lots to catch up on, as I said in the intro, because we spoke in very early January, and a lot has happened since, of course. But maybe we'll start with catch us up. Like, how has the economy changed? Is the economy better off right now than it was back in January?
Well, it's, obviously things have dramatically changed in the, 5 months or whatever since we spoke. I think, the biggest thing I was writing about in January was just asking the questions, are markets, the question, are markets prepared for a policy shock? And to me, there were some obvious signs growing that the administration's top priority was passing this tax bill. And they were looking to, rather than the stock market as kind of their barometer or yardstick as to, whether they're going to be achieve what they wanted to achieve, they're going to look at the bond market. Scott Bessent said we're very focused on the 10-year Treasury yield, and I think those two things go hand in hand, right? I mean, obviously now we've seen they're trying to pass this big, beautiful bill in Congress, and the bond market is potentially, becoming a little nervous about what that means for the fiscal deficit. So when Bessent says he's looking at the 10-year Treasury yield, he's looking at what do I have to do so that the bond vigilantes will allow us to pass this tax legislation. So I think that helps explain DOGE, trying to cut a lot of spending. I think it helps explain, the tariffs, try and raise revenue. And I think a lot of the initiatives that the administration has been trying to implement are all aimed at, setting the stage to pass this tax bill. And if they need to slow the economy and even create a recession to bring interest rates down and make tax cuts more of a necessity, they're potentially willing to do that. So I think we've seen this play out over the last 5 months. We have seen a policy shock, to the markets. Obviously, that created the big sell-off in April, but markets have come around to the idea that maybe the shock isn't going to be as big as initially anticipated. So, and that kind of explains the rally. But I do think what we're seeing is a monetary regime change that is the sort of thing you don't see very often, once every multi-decade period, and that has enormous implications going forward.
Yeah, no, absolutely. Jesse, lots of you mentioned we got to break down a little bit further, and I need to follow up with you because you just said like the U.S. government is trying to deliberately slow down the economy, and we have to talk about like how are they doing that, and are they being successful, and like why are they trying to hurt the economy like that? Like really, we have to talk motive, of course, and just be a bit more specific
Sure.
here. If you could elaborate on that, it'd be fantastic.
I don't know if they're deliberately trying to create a recession. I mean, right? We're speculating as to what the motives are of the administration. But I think to the extent you want to bring down long-term interest rates. How do you make that happen? Well, Trump can, berate the Fed. He can berate Powell and try and pressure him to lower short-term interest rates. But the way you bring down long-term interest rates is you really need to bring down inflation expectations and estimates for growth. And so how do you do that? You need to slow the economy. You need to cut spending, which they tried to do. There's debates as to how successful they were to try and cut spending at all, on the DOGE side of things. And they're trying to raise revenue too, to kind of bring down some of those worries over the cost of this new tax bill. So I think that, and then through the tariffs, right? The tariffs have an impact on economic activity as well. So, the uncertainty created, all of those things should probably slow economic activity and help to bring down interest rates. I think if you're thinking in terms of that logic. So I think a lot of the intents of the administration are, okay, let's implement a lot of these things that are intended to address the fiscal deficit and potentially slow the economy, maybe help bring down interest rates, and that will essentially put the bond vigilantes at bay and allow us to kind of pass this big, beautiful bill.
Now, really interesting because we've just gotten the U.S. consumer inflation expectation data this morning, and it's down from 3.6 to 3.2%. So it is coming down. But I'm trying to figure out if it's just the tariff uncertainty that's being taken out of the equation here, or if there's more to it. Because I think I said in another interview earlier, I think it was with Jan van Eck here, that it feels like we're a bit in the eye of the hurricane. Everything's calm. Goldilocks was a term I've used last week, or financial media has used last week. But I feel like the worst isn't past us just yet, like in terms of tariff talks, for example, between the U.S. and China. So can you put some perspective around that for us? Like, how do you factor that into your models here?
No, I think that's exactly right. I think we have not seen the inflationary impact yet, or we're just starting to see the leading edge of the inflationary impacts starting to hit the economy. Another Fed survey came out, I think it was the New York Fed, surveyed businesses within its district, and, by far, companies are all raising prices to deal with the tariffs. Even companies that aren't affected by the tariffs are raising prices because they have an opportunity to do so right now. So we're just going to start to see the inflationary impacts, and we're also starting to see just the early signs of the economic slowdown. I think the Fed's forecasts have essentially been for stagflation for the second half of the year, slowing growth and rising inflation. And so I think right now we haven't really seen either one of those materialize in a meaningful way, but the soft data certainly points in that direction on both counts, that inflation is coming, that we're going to see renewed inflation, we're going to see weakening economic growth. And that's not a healthy recipe for the stock market or bonds for that matter.
Yeah, just last week, OECD reduced its growth or global growth outlook yet again, second time this year. IMF, last month or so came out with a lower growth expectations as well. So definitely stagflationary environment. But Jerome Powell and his Fed presidents caught a lot of flack from the White House when they said stagflation, right? Or they didn't say stagflation actually. They said what you said.
They didn't use the word, but they said they said the definition, which
exactly
is for growth, rising inflation. So yeah,
but they caught a lot of flack for it.
Absolutely, because nobody wants to admit that these policies are stagflationary, even if that's what the ultimate effect of them is. And I think the Fed is really just kind of telling it like it is and saying, these are the risks that we face. Is that we're very likely to face a situation where unemployment continues to rise because of all the uncertainty and people putting off investing in their companies due to the uncertainty around the tariffs. At the same time, raising prices, higher cost of goods, and all of these things are happening. So yeah, you have rising inflation pressures at the same time. Weakening growth is also, I said it's a bad recipe for stocks and bonds. It's also a very difficult recipe for the Fed to say, okay, wait, we can't cut interest rates if inflation is still a problem, right? We're 4 years now with inflation well above the Fed's target and still no expectation. The Fed doesn't expect it to come back to target anytime soon. So we can't really, start cutting interest rates when we haven't met our target for that long on the inflation side. Then you have, signs of rising jobless claims and unemployment on the other side, which would argue for rate cuts. But, so the Fed is kind of in a pickle.
I got to challenge you a little bit on the jobless claims, because that was my next topic I was going to go to with you here, is the jobs market, because we're sitting at 4.2% unemployment rate, NFP, like non-farm payroll, looks okay, nothing too crazy. It's mostly government jobs and federal jobs that are being lost. Just part of, you mentioned Doge earlier. How is that being reflected, and how is that even a proper measure when it comes to like jobless unemployment expectations and things like that to take into account?
I think that the jobless claims measure, non-farm payrolls, is famously one of the most lagging of economic indicators right now. So it says for things right now, 4.2% employment, things aren't terrible. But, the last couple of numbers were revised down by 95,000 jobs or something. And so, if you just apply that to the latest report that we got, that puts you much closer to something, similar, or a similar reading to the ADP report, which showed very, very weak private, payrolls. And so I think that's probably more reflective of where we are, is a significantly slowing jobs market. I mean, you see, especially for recent graduates, you look at the unemployment rate for recent college graduates, and it's about as bad as it's been at any point in, a decade plus. So, and then a lot of the unemployment rate staying low is people leaving the labor force, right? So that's not super healthy for the economy either, that people are, leaving the labor force. So if that effect, if people hadn't left the labor force, I think I saw one measure that suggested if the labor force had just remained static last month, the unemployment rate would have gone from 4.2 to 4.6%, which is a very big difference. So, I think it's very difficult to read into these numbers when you get them in real time. And that's why the soft data is so important. I mean, you see like the University of Michigan survey, and people, more worried about the employment market, the labor market, consumers more worried about that than really any point since the great financial crisis. It tells you that probably the underlying jobs market is much weaker than the lagging payrolls report would suggest right now.
Yeah, no, it's a good segue to talk about the private sector here, Jesse. And just looking at some private sector added 37,000 jobs in May, lowest in 2 years. ADP says Doge, of course, is taking away the government jobs here, so it's all adding up a little bit. But we haven't heard those big announcements like here in Germany. Like just last week, I've heard 100,000 employees or auto workers are supposed to be laid off here in due course, but we haven't really heard anything of that, like headline worthy, like that out of the US yet, have we?
No, I mean, there's consistent layoff announcements, and especially in the tech sector. We've seen, Amazon announcing layoffs, Microsoft announcing layoffs, and a lot of that is just due to try and offset the rising costs of AI. Right? They're spending so much on AI capex right now. That's going to start to flow through, expenses, depreciation expenses coming up in the next few quarters. So they need to really cut expenses to try and preserve profit margins. But we haven't really seen the type of layoffs that you would expect once kind of recession is underway. And I think that's probably something that's coming. But I think through the pandemic, a lot of companies learned that, they laid off really quickly in the pandemic, and it was difficult to hire back. So we have these demographic challenges right now, too, which also kind of, I think, are supporting the labor market. So we have this shrinking labor force is a product of two things right now. It's one, the aging of society, right? We have more people aging out of the workforce, baby boomers retiring. And so the share of the working population is naturally shrinking relative to the overall population. That is an important inflationary force, longer-term inflationary forces. You have fewer people working to support the economy, puts pressure on wages. And so that, I think, is helping the labor market. But also, one of the big factors of the growing of the labor force the last few years was massive immigration that we had into this country. And so the reversal of that is, we're got protests in LA and things right now with people being, mass deported. And so that is also another shrinking of, the labor force. So I think when you have shrinking supply of labor through deportations and through people aging out of the workforce, it is just a couple of more incentives for companies to say, hey, we really don't want to, fire people unless we absolutely have to right now, because it might be really difficult to hire people back.
Maybe just a, I don't know, it's like provocative follow-up question here, but were those people that were being deported in the workforce in the first place, were they counted? So just for me to understand, like if they were illegals
Yeah,
and
I
deported,
think
like,
it was
so I'm curious.
my impression, my understanding is that a lot of the immigration that was allowed over the last 4 years was intended to reduce inflation. Right, we had such demand for labor when the economy reopened after COVID, and shortage of labor supply, that is massively inflationary for wages and stuff. Right, you saw like job openings just go through the roof. You saw the percentage of wage increases for job switchers was a sign that the job market is super tight. That went really, really high. So it was very huge incentive for people to jump to different companies and take better offers, and just super tight labor market. So I really do believe that the previous administration thought one of the best ways we can help to bring down inflation is loosen the labor market a little bit by allowing a lot of people into the country to help kind of loosen it, increase labor supply a little bit. So, and they did that more than a little bit. And so I really do think that helped to bring down inflation in an important way by loosening the labor market. Now we're doing the opposite. So we're kind of tightening the labor market a little bit at the same time the labor market is weakening. And so those kind of things just, I think, offset each other right now.
Okay, no, I appreciate you clarifying that. It makes a lot more sense in that regard with that explanation there, Jesse. Talking about private sector as well, like which sectors are doing well right now? I know you follow them quite closely. Who's doing what? Like the home builders, like the big box retailers, how are they being impacted by the tariff discussions and just the economic uncertainty here?
Well, you could look at how their businesses are doing. I think we're hearing from a lot of companies, right, that have been disappointing earnings expectations recently. It just seems like a lot of companies that have done phenomenally well in recent years. Chipotle and Lululemon are kind of a couple that come to mind that have really disappointed in their last couple of earnings reports. Suggests that the consumer is a lot weaker than than the overall stock market measures would lead you to believe. I also like to look at what I call the inside of the stock market, or what actually Stan Druckenmiller has called the inside of the stock market. He said, famously said that the best economic predictor he's ever seen was the inside of the stock market. By that, he means the relative performance of the most economically sensitive sectors within the stock market. So as you mentioned, home builder stocks, retailer stocks, small caps, materials, these types of things. And the relative performance during this rally, the relative performance of those groups has been very weak. Look back to 2020 when we bottomed in that March-April timeframe of 2020, and the stock market reversed strongly higher. The sectors that led to the upside were this inside of the stock market. It was small caps, it was home builders, retail stocks, these types of things that led to the upside, and that was a very good sign that the economy was going to be a lot healthier going forward than was originally anticipated. Right now, we have the exact opposite, which is, the stock market has rebounded very strongly, but it's been really led by a return of these Mag 7 stocks. And these economically sensitive sectors have really lagged significantly. In fact, the relative performance of these groups has made new lows, even as the stock market has made new highs. To me, that's an important warning sign that, as you suggest, I think the good metaphor you used was we're in the eye of the storm right here, right now. And I think that's kind of what these economically sensitive sectors are pointing to. That we haven't gotten an official all clear yet on the economy, and in fact, still things could continue to deteriorate in the quarters ahead.
Yeah, no, absolutely. Like I'm a bit confused by how well or how quickly the stock market rebounded after Liberation Day as well. We're back to 6,000 roughly in the S&P, mostly retail driven though. Like I'm curious, like how do you interpret that? It's mostly retail buying. I remember being in New York about 3 weeks ago, and it was big headline news that retail bought the most amount of stock in the S&P 500 ever. It was like $4 billion before 12 p.m. that day on that Monday. So they came in like in a frenzy buying up the stocks. Why do you think that is? Like, why is retail still so gung-ho on the S&P 500 in the main markets despite everything we've just talked about?
Yeah. Well, I think there's two things at work. One is just this kind of the retail risk appetite, which, it's been 15 years now that the buy the dip behavior has been rewarded for 15 years. And so you think about how many market participants have been in the market now for more than 15 years. We've actually seen a real bear market in 2008-9 or in 2001 two, during the dot-com bust, let alone the 1987 crash or the 73-74 bear market, which was extraordinarily painful. And I think there are a ton of people in the market today whose entire experience of markets is the last 15 years. And so all they know is that buy on weakness and you can't lose. And so I think that's driving part of the behavior and that risk appetite, especially in things like leveraged ETFs, which have become massively popular. I think there's something like $100 billion in leveraged ETFs now, which is a new dynamic we haven't seen in a previous market cycle. There's another dynamic that's at play too, and my friend Mike Green has really kind of probably done the most research about this. It's just the flows into index funds are highly correlated to the labor market. So when the labor market is strong, right, there's a lot of money going into these 401k plans, which are automatically invested in the S&P 500. And that's just a persistent flow so long as people have their jobs. Now, over the last 6 months, those flows and the labor market, right, we've seen to start to kind of weaken. And so I think if you were to see the labor market continue to weaken, which I think is very likely, those longer term passive flows that come from just automatic monthly deposits into retirement accounts will continue to slow as well, and potentially go into reverse. We've seen already, I think, with the late, one of the signs that I've noticed is the Wall Street Journal's reported about the number of people taking loans out of their retirement accounts to help meet living expenses. That's grown dramatically so far this year. And so, that's the sort of trend that I think if the labor market would continue to weaken, you'd expect to see that continue. And then also these persistent passive flows also potentially weaken in a way that would, make the markets vulnerable.
No. Jesse, before we move on, let me ask you a summary question, maybe to sort of put a bow around this segment here of the conversation. But it's like, what is the market pricing in right now?
The market right now, if you value it, I'm sorry, I laugh because it's the market is more highly valued today than it was pre-pandemic. And that's ironic because where were interest rates pre-pandemic? Interest rates were on the floor, right? We had this super low interest rate environment from 2009-10 really till 2020, a decade of 0% interest rates and negative interest rates. The market is the PE ratio, right? We're 26 times trailing earnings or something on the S&P 500, 22 times forward earnings. That's higher than anything pre-pandemic, and interest rates are higher. So you think discount rates are higher now, valuations should be lower. So if you look at something like the equity risk premium, just compare, the forward earnings yield, on the S&P 500 to something like the real interest rate, the 10-year TIPS yield. We have one of the largest gaps we've ever had in terms of that. In other words, the equity risk premium, the amount you get paid for taking risk in the equity market, is lower than it's been really since the dot-com bubble. So to me, that says, stocks are pricing in a return to ultra low interest rates. What do you need to get to see a return to ultra low interest rates? You need deflation. You need some deflationary shock. Kind of like the great financial crisis, and you probably need a massive tightening in fiscal policy as well. And I don't think either one of those things are likely, right? We don't see any initiative and impetus by Congress to rein in fiscal, which would have that kind of deflationary impact. And everything else, as I point out, demographics and deglobalization, all these things point to sustained inflation. So if real interest rates are going to remain elevated, equity valuations are extremely overvalued right now, which I don't think, many of these, especially retail market participants, understand how overvalued markets are today relative to real interest rates.
I think last time we spoke, you used the Buffett indicator, GDP versus
Yeah.
market cap, or market cap divided by GDP. Probably still elevated, I would assume. Probably hasn't come down
Yeah,
much. It
that's
actually
another way
probably
to
dropped, but is right back where it was.
exactly. That's another good way to look at it. A different way of looking at it that doesn't really factor in interest rates, but it's just the market cap. It points to the financialization of the economy has gone to a degree that we've really never seen before in this country. And it's about as high as it's ever been right now, the Buffett yardstick, which helps to explain why Buffett himself has 350 billion in cash right now, the largest cash position nominally and relative to the total assets under his management that he's ever had. He's just not seeing opportunities in the equity market, and I think he's honestly worried about risks to the equity market, especially during a time of, as I mentioned earlier, a monetary regime change.
Yeah, it's like that was the next segment I want to talk with you about. It's like the monetary regime change. Like, what does that really mean? Can you break that down for us? Elaborate on certain topics. I'm sure you're talking bond market, Fed policies, and things like that. But in your own words, what do you mean by that?
Well, we've had this. We've gone through multiple monetary regime changes, and my friends at Gehring and Rosenzweig have done some really interesting research on this, and what it means for the commodity space. But they point out that every time we get a monetary regime change, it's usually indicated by a rapid devaluation of the dollar relative to the gold price. So we saw this in 1971 with the Nixon shock, right? We essentially closed the gold window, broke the convertibility of the dollar into gold at a fixed rate. And that was, kind of the first real monetary regime change. We saw another one kind of in the wake of the, Asian currency crisis, emerging market crisis in the late 1990s. And that was kind of really at the same time when globalization really accelerated in a major way. And the twin deficits of the United States really began to trend, wider, significantly wider. And so that's persisted for 25 years now. And it's very clear, the administration makes it very clear that, this cannot continue, right? We can't continue this trade deficit, continuing to widen and essentially selling off at U.S. assets in exchange for consumer goods for much longer. And so the design, the tariffs and everything, it's interesting to me, the parallels between today and the Nixon shock in 1971. So not many, I think, people understand, we closed the gold window because we were running out of gold, and people were just, French central bank and others were saying, okay, we're going to convert our dollars for gold. We'll take the gold instead of dollars. Thank you very much. The Treasury was running out of gold and said, okay, we can't afford to do this anymore. But at the same time, as part of that, the Nixon administration, and I think Paul Volcker was Undersecretary of the Treasury at the time, it was really his impetus to say, we need to make a change. And part of the change they made was Nixon imposed 10% across the board tariffs on all trading partners in order to negotiate a revaluing of foreign currencies higher, a devaluation of the dollar, to make to try and bring things back into balance. So I don't think we say history rhymes, even if it doesn't repeat. These 10% across the board tariffs are another effort to try and revalue foreign currencies, especially the Asian currencies, right? Yen, Chinese yuan are exceptionally undervalued, higher. That's what I mean by a monetary regime change, is the dollar is overvalued relative to partners. The trade deficit is too wide. These things need to be addressed. And that has big implications for a lot of different asset classes.
We're 2 months post-Liberation Day now, or pretty much exactly 2 months post-Liberation Day. How do you think, how successful have the efforts been so far?
Well, there's been no actual deals announced. So, you can't really say they've been successful. We also don't even really know what they're negotiating. But there are hints in some of the markets, right? We see, what happened in the Taiwanese currency market. And, Hong Kong interest rates are 0% today due to strength in their currency and trying to continue the pairing of their currency with the dollar, and fixing, fixed currency rate. And so, there's signs in the markets, right? One of the things that I'm looking at that I think is most interesting right now is institutional investors are taking a massive position in the Japanese yen. And I think that is a front running of what they see as inevitable strength and inevitable reevaluation of the Japanese yen to the upside, right? It's so extraordinarily undervalued. Bank of Japan needs to continue to normalize interest rates. And if there's a kind of a reshoring of capital back to Japan, whether that's, just Japanese capital or that's, carry trades, that's, I think, what institutional investors are trying to prepare for right now is a move in the yen higher. So I think that, those are the types of seismic flows that could affect markets dramatically, going forward.
I was going to say, like, the U.S. is highly dependent on liquidity coming out of Japan, for example, and a weaker yen, for that matter, with rising bond yields in Japan. As you said, like, it's logical that money is flowing back, that carry trade slowly falling apart here. Like, what are the implications here? We're seeing higher bond yields in the U.S. already. We got auctions. I think we had a 3 and a 6 month auction today. I haven't really seen any outcomes or anything. I don't track that kind of stuff too closely unless there are any what do you call it? There's any drama, quite honestly.
Yeah.
But what are the implications there for the U.S. in particular?
Well, I think, what we're Brad Setzer put out a very interesting piece this week, pointing to the demand for U.S. assets are not necessarily correlated to growth in foreign currency reserves, U.S. dollar reserves overseas. It's more, I think, the more due to the fact that overseas investors have believed in this idea of U.S. exceptionalism and the idea that returns are just better in U.S. markets. And so tons of money has flooded into the United States in recent years, especially since the pandemic. A lot of that's, Japanese money. I mentioned Taiwan. A lot of these Taiwanese insurers were buying U.S. treasuries unhedged for currency risk. And, that's part of what's gone on with the currency market there is, having to reverse some of those mistakes in terms of investments. But if money is, let's say, the Japanese yen is to be revalued higher, interest rates normalized there, could potentially drive that. A lot of the money that was either, like as we mentioned, carry trade, borrowed in, Japanese yen and invested elsewhere could have to flow back, right? You have the currency risk, you're short the yen, and your borrowing costs are going up. You have to, sell the things that you bought overseas and pay off the Japanese-based loans. Or if you're just a Japanese investor and you're saying, wait a second, we've had 0% interest rates here for forever, but now we can go buy a 10-year bond at, 3%. Wow, this makes a great deal of sense. And we don't need to hedge for currency risk anymore because the hedged, returns we're getting from U.S. bonds are nowhere near as good as that. So that money could potentially flow back out of U.S. markets into Japanese markets. We haven't really seen any sign of that happening yet, but that's the risk. And that's really, I think, what the administration is kind of pushing for, is we need these currencies to be revalued. And that means an outflow from the U.S. of financial assets, and that's potentially a problem for those asset valuations here in the U.S.
Yeah. Maybe a summary question as well to summarize this segment. Where do you see the U.S. dollar and bond yields going then, Jesse?
Well, the dollar, very much like the U.S. stock market, is both overvalued and driven by valuation over longer periods of time. So, one of the good things about the Buffett yardstick in the stock market is it's a really good predictor of 10-year returns in the stock market. Buffett has famously said the price you pay determines your rate of return. You pay a cheap price, you get really good returns. You pay expensive prices, you get poor returns. And the same thing can be said for the dollar. When you buy the dollar when it's very overvalued, you're likely to have negative returns on a 10-year time frame. That's where we are today. And in fact, it's amazing to see the dollar correlate so strongly with those longer term returns. And so the weakness in the dollar right now that we've been seeing, was essentially predicted by its valuation, over the past few years. So, it suggests that the dollar's likely to continue to show poor returns over the coming decade. So I think that that's just the valuation, and that's based on things like Big Mac index and more complicated measures of valuation. But yeah, dollars, I think, just from a valuation standpoint, overvalued, likely to generate poor returns, and a part of that is now this catalyst of we need to address the trade deficit, and the currency is one way, maybe the primary way they're looking at addressing that right now.
Really interesting, because the Dixie or the dollar has huge implications, as you said earlier, on commodity prices as well. And we've seen that coming from the gold side. Super excited about seeing $3,300 gold today as we speak. But, copper is rallying. Silver is broken out just on Thursday. So what do you make of commodity prices in that regard then, Jesse?
Well, I think, I'm extraordinarily bullish on commodities right now. I think that when you look throughout history at these monetary regime changes, and again, I'm referring back to some recent research that Gehring and Rosenzweig put out, that these regime changes always coincide with regime changes in the asset markets. So you get a monetary regime change in 1971. What happens? The stock market goes into a lost decade. And in fact, 73, 74 were very painful. And the Nifty 50 stocks that were so popular in the 1960s did terrible in the 1970s. And the catalyst for that shift was the Nixon shock in 1971, a major monetary regime change. What did really well in the 1970s? Commodities did phenomenally well, right? Oil prices, gold prices, essentially anything related to real tangible assets did phenomenally well. And so that monetary regime change was the catalyst for a change in asset markets. I think we're seeing something very similar right now, where we're seeing another monetary regime change, very similar to that 1971 episode, which is creating stagflation, which, as I mentioned before, is very bearish for stocks and bond prices. It's the worst possible scenario you could imagine for financial assets. It's also the most bullish potential backdrop you could have for commodities prices. So I think this monetary regime change we're witnessing in real time right now is a very bullish catalyst to switch from financial assets to real assets. And there's a lot of other kind of supply demand dynamics unique for each one of the commodity sectors. But from a macro standpoint, I think this monetary regime shift, the stagflationary effects, are very, very bullish for commodity space generally.
No, I tend to agree. It's really difficult to come up with a bear case right now, especially for precious metals. When it comes to that, I struggle with it, quite honestly. Besides world peace, I can't come up with much else, quite honestly. So right. I'm struggling with that. Jesse, maybe a bit of a summary question to the end of our conversation here, but if you were to find $1 million under your pillow tomorrow, how would you invest that?
Well, in the commodities space generally, I think, we didn't mention energy, but I think when you look at the ratio of the oil price to the gold price, and this is one measure that I think is really helpful to determining where do I want to put new money to work. Oil price has almost never been as undervalued relative to gold as it is today. So, at the COVID lows, when obviously the oil price went negative, right? We saw a big disparity there. And then at the 2016 low, when the oil price had crashed for a number of years, it got pretty low back then as well. This ratio suggests that right now is a really interesting opportunity to invest in energy in the oil and gas producers themselves. I think, relatively speaking, it's very cheap, and I think going forward, the returns from energy are going to be, one of the interesting stats that I look at is over the last 5 years, really since the fall of 2020, energy stocks have generated a 30% average annual return, twice the return of the S&P 500, and at the same time, investors, in the XOP, the oil and gas producer ETF, the shares outstanding have dropped almost 70%. So you have one of the best performing ETFs over the past 5 years, and investors want nothing to do with it. That to me is screaming a contrarian buy opportunity.
Yeah, gold is not contrarian anymore. As much as I hate to say it, gold has gone mainstream, right? It's finally done what we always thought it would do.
Yeah.
Well,
I think
maybe go ahead.
I was going to say, just the message from gold is important, though, right? The fact that the dollar is rapidly devaluing relative to gold points that this monetary regime change is underway. It's also, gold is usually a good leading indicator of the rest of the commodity space. So I think gold, the strength in gold, we could see that kind of broaden out to the rest of the commodity space over the next 12 months. And so that's a bullish sign, I think, for the asset class.
No, 100%. Like silver just breaking out sort of is a sign or a testament to what you just said. It's happening. Yeah. It's following suit. Gold-silver ratio of over 100 wasn't feasible in the long term anyway. So I think we all knew that. Jesse, wonderful conversation. I really enjoyed having you on. Where can we send our audience to follow your work?
TheFelderReport.com is my website, and I write about all this kind of stuff consistently. Put out a free weekly blog post where I highlight 5 things every week that I find most interesting during the course of all my research and reading, and usually those are based on a lot of the themes that we talked about today.
Fantastic. Jesse, thank you so much for joining us. Tremendously appreciate it. We'll have to have you back right after the summer to see where we stand and whether the hurricane has passed us or whether we're still in the middle of it. So lots to look forward to, of course, and appreciate it. Thanks so much, Jesse. Everybody else, thanks so much for tuning in here to Soar Financially. Tremendously appreciate you watching. Leave a comment, leave a like down below. How are you positioned? How do you think things will shape out? And how do you think the tariff war is going to end as well? Really curious what you're thinking, because I read all the comments and I try to include them as much as possible here in my line of thinking, my line of questioning. So leave your thoughts down below. Thanks so much for tuning in. We'll be back with lots more here on Soar Financially. Take care out there.